Hello world, hello Australia, it's Jamie Burke here, the Crypto Koala. Now today guys, I've got a very special guest. Tony Sycamore is with us today. So Tony is director and founder of TechFX Traders. He makes regular appearances on Sky Business News, on the Foreign Exchange Program, and he's a member of the Australian Technical Analysis Association. Great to have you on the day, Tony.
Thank you, Jamie. Thank you for having me on the show.
It's just tell us a bit about yourself and the reason for starting TechFX Traders.
Sure, Jamie. Yeah, so I started TechFX Traders almost 3 years ago now. We started on the June long weekend 2017, and I'd previously spent over 20 years working in institutional market roles at big banks, Macquarie Bank, BNP Paribas, Goldman Sachs, CBA, and I always had a bit of an affinity with charts and technical analysis, and I was doing technical analysis for our institutional clients and also as part of the Goldman's prop team for our internal trading team. And I had a bit of a thought that once my institutional banking career would come to an end, I wanted to take out the charting service, which I was providing to institutional clients, and take it into the private trader world. And that's something which was my initial plan. And since that point, we've taken those charts and we're delivering them to private traders, to clients of TechFX Traders. But I've also been approached and I guess had the idea that trading education was something that could be very, very big in terms of the demand for it. A lot of people wanted to take, the step into trading and didn't really know where to start. And I think where I sort of found myself operating is there's a lot of very snazzy operators out there, guys with Ferraris and flash cars and flash houses and very good marketing teams behind them. But I wanted to be a genuine operator, taking that 20 years of institutional bankings. 7 of those years I was proprietary trading at Goldman Sachs, which meant I was trading Goldman Sachs money for the bank. So someone with a real legitimate background in trading, I wanted to take that out and educate people. So we now have a pretty solid course in terms of our trading education. We've got a beginners for FX, and we've got an intermediate technical analysis, and then we've got a more advanced type program, which we show our customers and our viewers exactly how we traded at Goldman Sachs and how it's been modified and can be applied in today's markets, because things have changed since I was at Goldman Sachs. I left Goldman Sachs at 2009, almost 11 years ago. The markets have changed, the markets have evolved. So that's the second part of it. And then I'm providing market analysis as well. So I'm providing to my partner broker thoughts and ideas based on technicals and fundamentals about where I think markets are going and how I'm seeing markets evolve.
That's great stuff, Tony. It sounds like you've got a wealth of knowledge and some real big names there as well in the financial space. It seems like you can provide a more of a personalized service, and it seems like at the moment there could be some opportunities out there as well. So, and I even see that ASX 200 and crypto this week. And, what do you think are some of the key driving factors behind the latest rally this week?
Well, if we go back to the start of 2020, equity markets had a very strong run. I think globally, on average, we would have been up around 6 to 8%. I think the ASX was up around 7% coming into the period where the sell-off started, really, I guess, in earnest in late February. And I think probably like a few of the people that saw this coming, I thought equities were going to have a pullback. And I positioned my equity portfolios. Now, I hasten to add, Jamie, I'm not an equity trader. I'm not in and out of stocks. I just build stocks, a portfolio for the longer term. And then when I see something I don't like the look of, I might become more defensive. And in this particular instance, I sold 100% of my equities and my wife's equity shareholding portfolio in late January. I mean, I think there was a pretty big red flag when China locked down 60 million people. That to me was right. Let's be very, very careful. The other factor that I had in my mind was that I think I mentioned I'm moving house next Friday, and we bought a new house before Christmas, and our plan was to sell our existing house early on in 2020. But when I saw exactly what was going on in China, I basically just pushed that sale forward as quickly as we possibly could. Not that I think property here is going to drop significantly. I think that will start to be seen as a bit of a safe haven here in Australia because of some of the reasons we chatted about earlier. The cases here are tapering off, whereas there's real problems overseas. So that's kind of my positioning was get defensive, get early on in the year. And in terms of an equity pullback, I was thinking maybe 5 to 10% originally. And then as we saw the spread outside of China globally, I went, well, okay, we're probably looking more for a 10 to 20% pullback. And at that point of time, I started plowing my money back into local equities and also offshore equities. Unfortunately, I went about a week too early, and that was before before the real acceleration down towards the lows, which we saw into the March 23 low. And I always took a view that central banks would be very aggressive in supporting what became a humanitarian crisis and a real global crisis. I thought that potentially buying equities, you'd find support coming through from central banks. And certainly that's what's happened. You know, even last night, we're seeing the Fed come out there and supporting local and state governments, and we're seeing them buying high yielding bonds, things we've never seen before. And I think back to my time trading at Goldman's in 2009 and 2008, and the way the central banks acted then was a lot slower than what we saw back then. So I really liked, and I was really very proactive in thinking that, hey, look, these guys are going to come in hard and support things. Obviously, what's happened since that point, we had that acceleration. Stocks went about another 20%, as I mentioned, below where I bought. I wasn't buying on margin. I wasn't buying on leverage. And I also have a trading account. My trading account is one that I'm in and out of markets, mainly in FX and commodities. And that's done very well. We're up 10% for the year already. And your average ASX 200 is still down around 20%, the accumulation index. So I want to just be really clear that my stock trading is something which I do not on margin, none leverage. My actual TechFX traders ideas that we put out there are what I put in through my master account. And that's had a very good start to the year, mainly through gold and things like dollar, yen and whatnot. But anyway, my view was central banks would come in hard, come in aggressively. The virus, we could see what was happening in China, the tapering off there, whether the facts are to be believed or not. I'll leave that up to your viewers and listeners. But I think at the end of the day, we can see now China is getting on top of things. We've seen it in Korea and Taiwan. And I think similarly, we're getting on top of it here in Australia. So I see it as being a temporary shock. Of course, we're seeing a lot of unemployment, a lot of support needed. But I think that stimulus that central banks, that governments have announced will be around for a lot longer than the virus shock. And already we're seeing countries talk about easing those social distancing and relaxing some of the restrictions around the coronavirus, which I think's a good sign that, yes, we've got a very sharp, short shock and we're starting to come out the other side. I think people now looking to sell into this bounce. And I think they're probably the ones which missed the move on the way down. So it's something which I look and think, well, we got the red flag. We got the 60 million people in China locked down. Not many people were onto that. I don't think, obviously, some of our peers in the financial world were onto it, but I don't think the general populace was onto it. But now I think the people that are looking to sell bounces, they've probably already started shorting into this market. And as you mentioned, the ASX 200 and the stocks have closed superbly well for the week. And I'm a little bit staggered by that. We've got a 4-day long weekend. This is the first day. Markets aren't closed. Who knows what happens over the weekend in terms of news. But yes, a very good close to end the week.
It's very interesting to see how Australia and New Zealand have weathered during this coronavirus. And it could be the way it was treated with the government. And also, you know, comparing that, and I look at the coronavirus cases compared to other countries around the world, and it seems that now Australia's getting overtaken. So we're dropping down the line in cases. So it'd be interesting to see, you know, in comparison to European, especially the US markets going into the future, how Australia weathers. So it seems like at the moment, especially this week, the charts are looking pretty good for equities at the moment.
Fantastic. And for a charting guy like myself, I love looking at those, how many new cases we're adding. And yesterday, I think we were down to 85 new cases, the first time below triple figures in a couple of weeks. I'm very reliant, I'm very visual, so I like looking at those charts. And you're absolutely right. I think part of that is because the government, I think, got a real absolute caning because of its handling of the bushfires here along the eastern suburb. And they actually, I think, learnt from that, and they were more proactive, and they were probably earlier than some of the other countries. They listened to their advisors. And I think there was a little bit of a reluctance initially, which is what took the ASX down to 4,400. But as soon as the market regained confidence that these guys were getting ahead of the curve and doing what was needed, you've seen a good bounce. You've seen the Aussie dollar bounce from 55 to wherever it closed, 63.30. You've seen the ASX basically rally 1,000 points. So in an article this week, I mentioned that we've already had a bear market and a bull market in 7 weeks, which is purely a textbook definition. Yeah, 20% up, 20% down. But it gives you an idea of just exactly what's happening. But at the very core of that, I think the Australian government's done pretty well, as have the state governments, if you take the Ruby Princess aside.
Would it be fair to say that, that there is a bottom now, or is there some sort of signs and strengths or indicators that you're looking out for at the moment to sort of give a signal that we actually are starting to go back into a bounce back?
Yeah, so I'm an Elliott wave guy at the very core of my technical analysis, and I was looking, and I look at things like volatility index, the fear index, as we call the VIX. And I was looking at that up at around 85, and I think up during the GFC, it got to 92. So we're at those really extreme levels in terms of volatility measures. But I also thought, well, look, we've just gone 40% in 2 weeks. Basically, we unraveled 40% in two or three months, sorry. And during the GFC, that 50% decline, which we saw then, unraveled over 16 months. So I thought everything's just happening in fast forward here. And I wrote a couple of pieces for the team at City Index, who's my partner broker. I said, look, I think we've reached a turning point here. The worst is, I think, everyone knew about it. When everyone knows about it, they're all selling. There's a lot of panic. We saw a lot of funds, private traders, retail investors switching out of equities into cash, for instance. We saw some huge switches in that space, and that's when people are hearing about it, and that's often a sign of a low. And I wrote on the 23rd of March in an article, I said, guys, this is not the time to panic. We saw during the GFC, a lot of private traders liquidated their portfolios. They sold their equity portfolios at the lows, and then they were too scared to get back in. So I like to think that we're on the money there. I was just looking at how far it had come, how quickly it had come, the amount of central bank stimulus and government stimulus. And I have a bit of an adage, and I've learned this the hard way. Once these central banks want something to happen, they're usually pretty good at it. And they didn't want the whole system breaking down. And as much as the doom and gloom merchants out there get more and more bearish at the lows, you've got to look at what these central banks are doing. They're doing their swaps, they're providing liquidity, they're cutting interest rates, they're providing government support. You can't ignore that. These guys are big, they're powerful. Anyone thinks that these guys are out of ammo, they're not right. What the expanding the balance sheet leads to is a different story. And I think for the short term, yes, we've certainly got a low in place. I've been calling the S&P to get up to around this 2780, 2850 area. It's closed there. And I think now we can start to assume that we potentially could. Where we are now, I think we've got to get through this weekend. But this is the logical objective. This is where I thought we'd get to. So we've already had, I think, a rally of around 30, 40%. For me, it becomes a little bit more 50-50 here. And like I was saying earlier, I think the people that have been waiting to sell into it probably start selling into it about now. And potentially that maybe halts the market for a little bit. But whether they're right in the long term and the market goes back down or we go higher, I don't know yet. I think the easy money's been made from the bounce. And right here, I'm a little bit more 50-50 in terms of where we go from here.
I mean, something that stands out is, as you mentioned earlier on, is the volatility. I'm used to, crypto traders, Bitcoin traders, we're used to seeing this volatility. But to see this sort of volatility in equities is crazy. So
phenomenal.
It's phenomenal. And there's an interesting piece that I saw on City Index that you wrote, was about the VIX index. So what is the VIX index and what does that tell us? Can you explain that to the viewers?
So basically it gives you an idea on what investors are prepared to pay for protection when they think the outlook is particularly bleak. And we call it the index of fear. And what we saw was people paying extremely high premiums for downside protection in the S&P. and we got up to that 85, 86 area, as I mentioned, not far below the GFC low, which meant that people were panicking. They were going out there and just buying. It's like you or I going out to buy insurance for our car or our house at just any old price. We're not shopping around, just I need protection, I need protection, I need protection. So I thought that was a pretty good sign of the panic, and market lows and highs are generally created when there is panic. I think we can probably agree that markets are driven by fear and they're driven by greed. And that was a real example of fear, loud and clear. The bell was ringing there. So I thought potentially the VIX had reached a turning point, and I wrote that as well throughout the last 2 to 3 weeks. The VIX now about 50% off its highs. I think we're back into the low 40s. So it's still in an elevated status, but where I see the VIX settling is between 30% and 50%. I'm now thinking we're going to see a choppy period, maybe a month, 2 months. Good news, bad news, good news, bad news. It's 2.5 steps forward, 1.5 steps back. I think it's going to be a little bit of a tricky time for traders because we're going to get these whippy moves. The big move down, it's happened. Okay, anyone trying to look for that now, I think you've probably missed the boat. But I can see volatility, and it can make trading a little bit more difficult. So that's where I think we are now. VIX sits in a range between 30% and 50%, which means the market's still cautious, but they're certainly not paying for that premium like they were in late March.
Yeah, great stuff. So, you've been around since the GFC, and there's people comparing, this sort of scenario, and they'll say, oh, depression, recession. And you've sort of seen that, you've been trading for over 11 years. So, the GFC, it happened over 11 years ago. Can you see any particular comparisons? Is there any support lines that are from then till now that you can see in the charts?
I look definitely in the S&P 500. I remember this low very, very clearly in the S&P 500. It traded down to its GFC low on March the 6th. And the low that day in the S&P 500 was 666, which potentially should have triggered a few alarm bells in my head. But anyway, I went into the Goldman's trading room that day, and I got called into the manager's office, and we'd already seen a number of our colleagues leave, Bear Stearns, Lehman's, all through that period, traders and bankers. So this is one of the big differences between now and then. GFC was very much a financial crisis. It was bankers who were losing their jobs. This is more of a Main Street crisis in terms of the man on the street, the person working in tourism, real estate, in terms of, anything that's been impacted is more of a Main Street thing. The banking thing, it hasn't really filtered through into the, FX traders are still in banks working because they're deemed as an essential service. So the transmission mechanism is more Main Street as opposed to Wall Street this time around. But going back to that low in the S&P 500, 666, there was a very, very nice trend line which you could draw in the S&P 500. And I don't watch the Dow that much. I'm not really watching the NASDAQ that much. The S&P for mine is really the Bible of global equity markets, if I just want to look at global equity markets in one snapshot. And we did break below there when we traded down to that 2174 low in the S&P 500. However, it's back above there now, and there is some early signs of rejection. So potentially we're looking to reclaim that uptrend, which started 11 years ago at that 666 low.
Just want to talk about a little bit, because we've talked a fair bit about equities, but I want to talk a little bit about the currencies, especially the main currency, the Australian dollar versus the US dollar. So, is there any key signals that you're looking for there, Tony?
Yeah, the Aussie's an interesting one. I think at the end of the day, if you just roll up a chart and overlay the S&P 500 with the Aussie dollar, they're both going together. They both collapsed in March together, and they've both rallied higher since that point of time. So this is called correlation analysis, and it's something which is very, very big from proprietary traders and bank traders. We look at what's happening in one market or one asset class to give us a bit of a heads up on what might be happening in the asset class that we trade. So I watch equities a lot, but I'm an FX trader. I'm watching equities because of their link with FX, and then we bring bonds into the picture and commodities into the picture. So I like seeing the world in a very holistic, multi-asset type approach, if you like. And right now, there's one thing driving the Aussie dollar. The ride down was a sharp one, and the ride higher has been those two moving very much well in lockstep. If I want to put Elliott Wave on an Aussie dollar, I have to be pretty sure that what I'm seeing in the Aussie dollar is also represented in the S&P 500, because if by definition they're both going down and they're both going up, I should be able to see similar patterns. And right now, the patterns which I'm looking at are both have had a nice recovery from their lows, which I was thinking was likely to happen. And in fact, because I thought the S&P 500 was going higher, it overrode one of my conventional sell signals in the Aussie dollar, which I wrote about to my subscribers at TechFX traders. But right here again, things are moving back into that 50-50 space. We've seen the low. We've had a really nice rally. What happens here could just be some really wild fluctuations either side of, maybe a 5-10% range quite easily. But I think overwhelmingly it's a 5-10% range, but moving higher, if that makes sense.
Great stuff, Tony. Are you watching cryptocurrencies at the moment? Is Bitcoin on your radar? Is it something that you look at? Is it something that you've got an eye on at the moment?
Absolutely, yeah. I love Bitcoin. Not so much after my last trade got stopped out. I got stopped out on that wash, which happened in March. And that was a funny situation. But the answer to the question is yes, I do watch cryptocurrencies, but really only one or two. I watch Bitcoin, and that's pretty much where my focus is, because there's 1,500, 1,600 cryptocurrencies out there. I don't have time to follow them all. I'm just trying to get a bit of it, like I do with the S&P. I'm trying to get a bit of a headline act, and I follow that and I trade that. We've had some wonderful trades in Bitcoin. Back this time last year, the Bitcoin was sitting around that 4,000, 5,000 level, and we called it higher and we got on that move. It was a 200, 300% move that I think we ran up to that 8,880 high. A wonderful move. And we were lucky we got on that. We thought there was a rounded bottom, a couple of other technical indicators we looked at. From that 13,880 high, I'd been looking at the pullback as being largely corrective. We did pull back, I think got to about 7,000. And then there was that run back up to 10,500. And I tried to buy the pullback again. This was coming back into that February to March period. We could see that there was this unwind potentially about to happen. I thought, well, gold, I like gold. I've had some great trades in gold, as I've mentioned over the last couple of months. But I tried to add to that sort of exposure by buying Bitcoin. And unfortunately, I preempted a buy signal, which I confessed to. I wrote about this on City Index yesterday. I said, listen, I'm always very happy to stick my hand up when I've got a call right. And hopefully a few traders have made some money off our calls. But I've got to stick my hand up in Bitcoin. And I got that trade wrong. I didn't think Bitcoin was going to fall to 3,850. And that trade actually hurt me. It stopped me out. I moved to one side and I go again. And now I'm looking at where Bitcoin is in my world. And I see the fundamental story behind Bitcoin as being very, very strong. You've got central bank printing money, all this stimulus, which they're devaluing the currencies effectively and just printing more and more money. There's in theory, it should devalue the currencies, but you've got this limited supply of Bitcoin. What is it, 21 million or something that they can produce? And for that reason, I like the story. But what it showed again in February and March was that in that broad-based liquidation, which we saw across all cross-asset classes, I didn't see that coming. And I stuck my hand up and said, look, I didn't see that come, guys. But yes, the fundamental story remains fabulous, but I generally won't put on a trade unless I have a good macro and technical story. And when I find these two macros and technicals line up perfectly, that's when I'll put my trades on. And right now I can't see the technical aspect of it. The recovery from 3,850 does look a bit corrective to me. I'm not going to take the short trade because fundamentally I like Bitcoin. But I do need to see Bitcoin, get back above the 200-day moving average at 8,100. I would like to see Bitcoin to actually generate a buy signal, get back above that 10,500 high we saw earlier this year. So yes, I am watching it. I don't have a trade on it at the moment is the answer.
How I've seen it over, its performance throughout this whole coronavirus crisis is that some people have seen it as a store of value. So as equities was dropping, people were saying, "Oh, be treated like gold," and potentially, we see Bitcoin rally, and we see Bitcoin go up. But I guess how I see it is that there was a liquidity crisis and
Correct.
gold went down as well.
Correct.
But I guess fundamentally, what the case for Bitcoin is now is that you now have the US Fed have just added an extra 6 trillion to their balance sheet. So the case for inflation, the case for, as an alternative to the USD, that seems to be a stronger case than being a store of value than gold. So how would you see that, Tony? Is Bitcoin being a more of a gold, more of a store of value, or more as an alternative to a currency due to inflation?
Yeah, I don't see I don't see Bitcoin as replacing currencies. I think the natural monopoly that these currencies, these fiat currencies, enjoy in their respective regions, I don't see that as going away anytime soon. But as a store of value, in terms of should people be putting some of their portfolio, allocating some of their portfolio into Bitcoin and maybe one or two others, yes, I think there's a strong argument to that. I think where we have to be clear though is, are we just buying Bitcoin and we're going to hold it forever, which is one way of doing it? Or are we buying Bitcoin and we're trading it? And for me, I'm a trader. So I take it, even when Bitcoin rallied up to 13,880, I took profit, I moved on. So that's the way I'm looking for trades that go from 2 days to 2 months potentially. Your investors out there who talk about the longer terms of Bitcoin, I don't disagree with them, but my approach is a little bit more dynamic. They're just saying, look, buy Bitcoin at 7,000, wherever it is, and one day it'll be at 30,000 or 40,000. Probably their case is sound, but I don't trade like that. I'm not an investor in Bitcoin. I'm a trader, if that makes sense.
Yeah, sure, Tony. Just commodities wise, is there any particular commodities, like you mentioned gold? Is gold just sort of the one you're mainly looking at the moment from a trading perspective?
Yeah, it is. And gold's been driving, been very technically driven, I think. Plus we've got, this safe haven benefit of gold coming into play right now, and the monetary value that we spoke about being a little bit devalued. So yes, I think gold ticks a lot of boxes. Whether you buy Bitcoin and gold, if you're an investor, you probably buy both. For a trader, and this comes back to where I'm in gold, I've had a good run in gold. I squared up my gold long sort of on that 1620 to 1640. We saw gold reject 1643 and then pull back to 1572. And I think, like with equities, the easy money for me in gold has just about gone, if that makes sense. Much like the rally in equities, I think the easy money's gone. So it's 50-50 here for me, whether gold pulls back to 1400 and then goes to 1800, or gold just goes to 1800. And as a trader, I can't quantify my risk around that at the moment, so I don't have a gold position. But if you held a gun to my head and said, are you a buyer or a seller of gold? I'm definitely a buyer of gold. I'm definitely a buyer of Bitcoin. It's just finding the right levels. I like to marry these fundamental and these technical views with good risk reward money management. And that's what I can't do at the moment in a lot of these markets.
Yeah, definitely, Tony. Can you say, like, recently with the recent market activity, is there something in particular that you're watching? Is it, or is it like a basket of different things like currencies, commodities? Is there anything in particular that's really caught your eye at the moment, Tony, that you're keeping an eye on?
I have this view at the moment that everything's correlated, as we spoke about. We saw equities go down, we saw gold go down, we saw Bitcoin go down, we saw the big liquidation. And then we were speaking about how the S&P's gone down along with the Aussie, and now Aussie's rallying. So I like to put all the jigsaw pieces on the table and see how they line up. In terms of where we are right now, I'm seeing, I made the comment to a friend this week. I said, I think the next 2 months are going to be a really good opportunity for traders for people that have made money on this dynamic move lower. I think it's going to be a bit of an opportunity, unfortunately, for traders to give back some of that money. So I'm a little bit wary right now. I think we need to be careful that the easy money from the move down's happened. The recovery is underway. Does the recovery go much further than where it is now, which we're about that 50% Fibonacci? Does it get to the 78% Fibonacci? Do we get to 3,000? I'm unsure, and I don't have if you ask me what my favorite trade is at the moment, I really don't have one. I'm just, I do webinars a couple of nights a week. And I'll often tell the beauty of these webinars is we go over the educational material and the theory, and then we talk about where markets are. And in some of these webinars, I'll say, look, this, and this, I like this, and blah, 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 blah. And right now, I have to be honest with people. I don't have a strong view. I wish I did. I wish I had a really clear view on where things are. But my view is that we've got probably a month or two of choppy trading ahead, which doesn't make it easy for people who are traders. Potentially for your longer term traders, maybe there's something there. But the way I'm looking at it is that we've got to be very, very careful not to give back some of the money we've made.
Yeah, sure, Tony. I just like to say to the viewers, because make sure you do your own due diligence and research. Just take this, not as an investment advice. So yeah, Tony, thank you so much for your time. It's been an absolute pleasure talking with you, mate.
My pleasure, Jamie. Thank you for having me on the show, and have a great Easter.
Yeah, you too, mate. Keep safe, and I'll see you later, mate.
Cheers, mate. Thank you very much.
Bye.